Today we'll talk about Milestone 9 on the Next Dollar Roadmap, which is the final stop. It's the destination, if you will, total financial independence. Now, if you've made it this far, you're completely debt-free, you're saving quite a bit of your income every year in tax advantage retirement accounts. You're probably also doing so in a taxable brokerage account, which is going to give you lots of flexibility as you pursue dreams and other financial goals for yourself. You're probably setting aside money for your kids' college education if that's important to you. There are lots of things that you've got in place, and you should take a second just to congratulate yourself. Pat yourself on the back because you've done a lot of hard work and now you're in great financial shape. Now, unfortunately, this doesn't mean all of your financial worries are behind you. Now, sure, it's a lot easier to deal with monetary headaches when you actually have money than when you don't, but now you're the CFO of your own financial fiefdom. And along with that comes the responsibility of managing and preserving your net worth or your assets, your money, and using it well. Now, to that end, we're going to cover several concepts in this video that really you should be thinking about all along in the roadmap, but really, I guess they reach their crescendo here at Milestone 9, which is why we're covering them now, that being insurance, giving, and also estate planning. Let's start by talking about insurance. I'm going to try not to spend a lot of time here. At a minimum, I suspect you already understand that you need coverage for your health and your car and your home if you have those things. If you don't have insurance coverage in these areas, there's potential for personal liability there, and especially with your health, a huge expense that you can't control. And that's true no matter where you are on the roadmap. Go back and take care of that if you haven't already. When you compare the premium cost for this type of insurance with the potential risks, it would be foolish to go uninsured in these areas. Now, with that said, there are two other types of insurance that I would like to spend more time on. I want you to consider as well. One is life insurance, and the other is umbrella insurance. Let's start by talking about life insurance. If there are people in your life that are dependent upon your income or some other critical role you play in their lives, like you care for them, then you need life insurance. The natural purpose of life insurance is to replace income in the event of one's untimely death. Now, most commonly, if you have a spouse or kids whose basic needs are met thanks to your employment, then you need coverage to provide for them in case you die. Now, having covered the common example, there are other scenarios where you should consider having life insurance. First off is if you care for others who depend on you and they need to hire that support if you pass away, like your stay-at-home spouse or your caretaker for elderly parents or a loved one with special needs. Another is if you're married and your sole source of income is a pension that lacks benefits for your spouse or survivor benefits in case you predecease them. You could use life insurance or an annuity to cover them in case you die and the pension benefits stop, so they actually have an income after that. Another is if you have debts that would be challenging for your heirs or for your estate to manage. If you own a business that has obligations that would be difficult for your heirs or your estate to manage, or if you're the owner of significant assets that won't divide very evenly among your heirs. So like you own a business that's highly valued, or you own a lot of land that's highly valued, or a home that's highly valued and it's hard to cut that into pieces. Life insurance can also provide some flexibility there. There are many ways to insure one's life, but term life, 99 times out of 100 is the way to go. Term life insurance is affordable, it's predictable, and it doesn't leave you obligated to maintain a policy if your circumstances change and you no longer need it. The alternative is permanent insurance, which I typically don't like for a lot of reasons, not the least of which is the cost of it compared to term life. In fact, I wrote a post for our website a few years ago where I compared term life insurance to whole life. I actually went out and got quotes for myself. And over the long term, I calculated millions of dollars in lost opportunity cost by using a permanent insurance policy. The second type of insurance I want to talk about is umbrella insurance. And as the name implies, umbrella insurance covers everything, at least everything your other policies don't. If the value of your assets exceeds the liability limits of your other insurance policies, then you need umbrella coverage to protect your assets in the event that you're found liable for damages. So for example, let's assume that your homeowner's policy provides $250,000 of liability coverage, but someone's injured on your property and they're awarded $500,000 in damages in a lawsuit. Your insurance company should cover up to that $250,000 limit, but the rest would be up to you. Well, if you have other assets like retirement accounts, stocks, personal property, or etc., you could be forced to liquidate these things to cover the amount that you owe. An umbrella policy would step into that gap for you and protect those assets as well. And by far, one of the best things about an umbrella policy is that the premiums are cheap compared to the coverage they provide. I currently have $1 million in umbrella coverage for a little less than $12 a month. If I bumped it up to $2 million, I think it only costs me about $6 more each month. So I'm actually considering that. So it's kind of a no-brainer if you have assets that you could lose if you're sued or you have some major liability circumstance. Now keep in mind that your insurance company may require you to have certain minimum coverages on your homeowners or your auto policies before they'll agree to grant you an umbrella. All right, the second major topic I want to cover is giving. I briefly touched on giving way back when we covered budgeting. I mentioned that if you give as a part of a spiritual belief, then you should prioritize that above all else. Now, if you give as a matter of personal preference, then hopefully it's something you started doing before milestone number 9. But now that you have wealth and you have assets, maybe there's some things that you want to contribute to, some causes that you want to support. Personally, I feel like giving is one of the funnest things you can do with money, but there are ways to do it efficiently. So let's walk through some of those now. The first one is donating appreciated shares. This is one of my favorite giving strategies. If you have a taxable brokerage account with appreciated shares of stock, that means stock that has grown in value, or some other securities that have grown in value, and you have charitable goals, ambitions, and you want to give, then donating shares of these assets is a great tax-saving opportunity that will allow you to make a donation and capture a double tax benefit without altering your asset allocation at all if you don't want it to. So if you donate cash to a charity, the process or the cash flow looks something like this. You start with income that you receive for work. You pay income taxes on that income. You get your paycheck after taxes. You write a check to charity out of your checking account, and then you get a tax deduction when you file taxes next April. But when you donate shares, you're going to change the process a little bit. The first steps are the same. You still have income from a job. You pay income taxes on that income, then you get paid. Okay, it's in your checking account. Now, normally at this point, you're going to write a check to charity, but instead, in this case, we're going to deposit that money to that taxable brokerage account. We're going to buy new shares in equal value to the shares that we're going to donate to charity, and we're going to donate those appreciated shares to charity. So basically, you're going to end up owning the same value or same amount of stock that you had, but now you've made the donation of shares instead of writing a check straight to the charity. You're going to still get a tax deduction for that donation, and you also get a free stepped-up basis in the value of the shares that you donated. Let's walk through an example so you can see this better. Suppose Phil Philanthropist donates $2,000 a year to his local art museum. Now, by writing a check, Phil would receive a nice little deduction for his gift by reducing his adjusted gross income by $2,000. But if Phil donates $2,000 of stock instead, the art museum still gets the full value of the $2,000 donation. Phil still gets the tax deduction, but Phil also receives the benefit of a stepped-up cost basis on his stocks. So assume the stock that Phil donated is worth $80 a share when he bought it, but it appreciated to $100 a share when he donated it. Since Phil donated 20 shares, $2,000 at $100 a share, he will avoid future capital gains tax on $400 of appreciation at 20 shares that appreciated at $20 a share. So if Phil's in the 15% capital gains bracket, that means he saves $60 just by donating shares instead of writing a check directly. Now, this is just a simple example with small dollars. The more you donate and the more frequently you give, the more valuable this technique becomes. There are some things to bear in mind using this strategy. It only works for long-term holdings, which means that you need to own the donated security for at least 1 year to claim the deduction. Also, if you donate shares that have been owned less than a year, only the basis of the stock or the donation is deductible. None of the appreciation will be deductible. Also, you wouldn't want to do this with shares that have lost value or depreciated in value, because you'd be surrendering an opportunity to tax loss harvest instead. Next, donate shares with the largest unrealized gains to maximize the value of the step-up in basis. Also, stock donations are limited annually to 30% of your adjusted gross income, so keep an eye on that. Don't overgive and then not get the deduction for the gift. And finally, get a receipt of the donation from the charity for your records in case you get audited by the IRS. All right, the second gifting technique I want to talk about is qualified charitable distributions. This is very popular for those of you who have traditional or tax-deferred retirement accounts that are exposed to required minimum distributions as you reach your 70s. Now, as many of you know, when you reach RMD age, which is either 73 or 75, depending on when you were born, the IRS is going to begin making you withdraw or liquidate a portion of the tax-deferred assets that you have so they can be taxed. This is known as a required minimum distribution, or RMD. Now, if you need this money to cover your living expenses, then RMDs really aren't a problem. But if you have sufficient sources of income from elsewhere, an RMD is a taxable event you'd probably rather avoid. And that's where qualified charitable distributions can provide great value. A QCD is a method of redirecting money to charity that you would otherwise withdraw from your retirement account as an RMD. The donation is credited to you as an RMD, but it isn't taxable since it was given to charity. Now, you won't receive a tax deduction for this donation since it's coming from an account that hasn't ever been taxed, but it does mean that RMDs won't increase your adjusted gross income, which would have potentially put you in higher tax brackets. That means you could save money on your taxes, leave room for Roth conversions, keep the amount of your Social Security that's exposed to taxes lower, and also decrease your Medicare surtax. Now, other important notes with QCDs, the QCD must go directly from your account custodian to the charity. If it ever comes to you and you handle it, then it's considered a distribution and you won't get credit for the QCD. In 2025, each individual is limited to $108,000 in QCDs. One kind of quirky thing is you can begin QCDs at age 70 and a half, even though your RMD age probably isn't 73 or 75, depending on when you were born. It's because at one point, RMDs started at 70 and a half. So they kept QCDs at that age, but our RMDs have pushed back over time. Next, your RMD amount is calculated using your IRA balance from the end of the previous year. The IRS has tables, I'll put a link to those down below, that correspond with your age so you know what percentage of your balance to withdraw each year. Now, to count towards your RMD, the QCD must leave your account by December 31st of the same year as the required minimum distribution. And you can't make a QCD from a 401k, but odds are you'll have long since rolled yours into an IRA anyway. Next up are donor advised funds. Donor advised funds are managed by a custodian, usually like an investment broker or taxable brokerage account, who invests the money in the fund on behalf of the fund's benefactor and makes distributions according to the instructions of that benefactor. So as a giver, a donor advised fund allows you to set aside donations far in advance of when those donations will actually be distributed to the charity. And in the meantime, they can actually grow, they can be invested, but you still get a tax deduction in the year that you move the money into the donor advised fund. Another strategy is if you like making charitable gifts, but they don't amount to enough to actually exceed the standard deduction annually, so you can't really deduct them or itemize them on your taxes. A donor advised fund could allow you to combine several years of donations into 1 year, allowing you to receive a tax deduction for the full value of the donation in 1 year. So quickly, let's look at an example how this might work. Let's suppose Terry Tither has been giving 10% of her income to her church for as long as she can remember, and she wants to keep doing so until she dies. Now, over the years, Terry has accumulated quite a sum of assets in a taxable brokerage account, and she'd like to begin donating appreciated shares to her church. Terry's adjusted gross income is $60,000, which puts her $12,525 into the 22% tax bracket for a single filer in 2025. Now, Terry's annual tithe of $6,000 is technically deductible, but since it doesn't get her down into the 12% tax bracket, Terry still prefers to take the standard deduction of $15,000, leaving her with an adjusted gross income of $45,000. Now, after learning about donor advised funds, Terry realizes she can donate $18,000, that's 3 years of gifts, from mutual funds in her taxable brokerage account this year to reduce her adjusted gross income and claim a larger deduction. Now, this 3 years of tithing claimed all in one tax year reduces her adjusted gross income to $42,000. Now, in the following 2 years, Terry doesn't get a deduction for her tithe since it was already made in the first year. Instead, she uses the standard deduction of $15,000 each year to reduce her taxable income. So for the 3-year period, this is what her options look like. If she doesn't go with the donor advised fund, she gets $45,000 in adjusted gross income each year because she's using the standard deduction of $15,000 subtracted from her $60,000 adjusted gross income. So by using the donor advised fund, Terry reduces her adjusted gross income in the first year by $3,000 additional dollars, which amounts to $360 in the 12% tax bracket. And obviously this is scalable, so the more you give, the more you can benefit. Donor advised funds can provide great tax planning flexibility depending on your individual circumstances, so keep them in mind as you think about your charitable giving. In addition to cash and securities, most donor advised funds can accept less common assets like insurance policies, Bitcoin, restricted stock. For clarity, reach out to the manager of your donor advised fund to see what they will accept. Some companies do charge a small fee for managing your donor advised fund, so that's something to keep in mind. The fund manager also technically has control over the distribution of the money that's in the donor advised fund, so you want to do your homework to make sure that previous customers that use that fund or the manager of that fund were happy with the service, because the whole reason you're able to get a tax deduction is because it completely leaves your control. It's in the control of the custodian then. So be sure that they're actually going to fulfill your wishes with that money. Also, it's important to note that contributions to a donor advised fund are irrevocable. You can't take them back. That's important to note. So there's no take-backs, no drawbacks, no clawbacks. Once it's donated in the donor advised fund, it's effectively no longer yours. It may not go to the charity yet, but you cannot get it back. The only other type of giving strategy I was going to cover are charitable remainder trusts. I'm actually not going to cover those. I have a post on the website. I will link it below. Charitable remainder trusts are kind of complex. They fit a small handful of people, so if you're, just in the mood to really geek out, I'll put a link to it down in the description below. The final major topic I want to cover in Milestone 9 is estate planning, and we're going to start with a will. Now, a will is a document that basically records your wishes regarding the distribution of property or the care of dependents that are in your custody. If you die without a will, this is known as dying intestate, then your default becomes whatever the laws of your state are. So they will distribute your assets however they want based on whatever laws are on the books. Naturally, this can make your estate the subject of great frustration, anger, and even fighting among your descendants. And it's not uncommon, as you know, probably for heirs to spend away the total value of the estate on legal fees while they fight over it. Now, you may not think that you need a will until you have a high net worth or a family, but there are several reasons everyone with assets should have a simple will. First is it just makes life easier for your heirs than having nothing. Second, if you have kids, you can nominate someone else to care for your children instead of having to leave it up to a judge to decide. Third, you can specifically decide who gets what and how much, which is important to most people. And finally, perhaps most importantly, you can specifically decide who doesn't get anything and name that so it's really clear. If you have significant assets and you want to spare your descendants and heirs the headaches of probating a will, then you should reach out to an estate planning attorney and talk about establishing a trust. Now, a trust is a legal entity in which a third party, known as a trustee, agrees to hold assets on behalf of a trustor, a beneficiary, or multiple beneficiaries. Now, the trust is managed by a trustee upon the trustor's death. The trustor is the one who set up the trust, who then sees that the instructions of the trust are carried out. Now, one of the biggest advantages of a trust is that they avoid the probate process upon the trustor's death. This saves your beneficiaries a lot of trouble in receiving the assets of the estate and keeps details of the estate out of the public record. A trust can be very simple or extravagantly complex. It all depends on how they're set up and what you want them to do. They definitely require more time and effort to establish as compared to a will, but they can also provide a lot of worthwhile benefits for your heirs. In case you're curious, in 2025, I did a quick Google search. A typical trust costs between $3,000 and $5,000 to set up. Now, there are other documents a good estate plan should probably have in them, the first being a durable power of attorney. This allows an agent to act on your behalf if you're unable to do so for yourself. So such an option would be critical if you become incapacitated or mentally unable to make sound decisions about your finances and property yourself. The second is a medical power of attorney. Like a durable power of attorney, a medical power of attorney allows an agent to make medical decisions on your behalf if you're unable to do so. Third on the list is an advanced health care directive. This allows you to document instructions about how decisions should be made regarding your medical care if you're not able to do so. Normally, an advanced health care directive also includes a medical power of attorney and a living will, so you kind of get several things together typically with an advanced health care directive. Fourth is beneficiary designations. Be sure to keep the named beneficiaries of your various accounts up to date, as these elections will supersede other estate documents. So like on an IRA, if you leave someone listed as a beneficiary on the account, it's going to supersede anything you name in a will. So worst case scenario that I've ever heard is if you've been through a divorce and your ex-spouse is the named beneficiary on your IRA and you pass away, but you wanted to go to your kids, well, guess what? It's going to go to your ex-spouse. So be sure you keep up with that. Fifth is a letter of intent. This is a document that communicates who gets what to your executor, kind of as a guide for them. Odds are it won't be legally binding, but it will make their lives much easier as they try to guess how you would have wanted stuff distributed to others, or it spares them having to play referee or make a judgment call. If it's written down by you how you want things distributed, you'll spare them a lot of headache by having it written down. Sixth is guardianship. If you haven't already nominated guardians for any minor dependents in a will or a trust, then you need to name them in another document. Otherwise, the courts will do this for you, which is rarely ever good. So there you have it, the next dollar roadmap to financial independence. If I'm being honest, there's so much more complexity and depth that we could have gone into in all these milestones, but this broad overview should give you a pretty clear picture of how you can manage your own finances to meet your goals and ultimately to reach financial independence. Now, for more information about the topics we've discussed on the Next Dollar Roadmap, please continue checking out our website as I post new content each week, or you can subscribe to our YouTube channel if you prefer to digest topics through video. As always, I'm grateful for your time and your interest. God bless and take care.